So you've got a great idea. We all have them. But how do you actually figure out if that brilliant concept is going to be a home run or, well, a total bust? Today, we're digging into exactly that. We're going to learn how to build a cash flow statement, which is hands down your #1 tool for turning a great idea into real, tangible value.
And really, it all boils down to this, doesn't it? Is this thing you're passionate about going to be a gold mine, or is it just going to be a money pit? Before you invest all your time, your cash, your energy, you need a way to tell the difference. And that is exactly what we're going to figure out today.
Okay, and this right here, this is so important to get. There's a huge difference between accounting profit and actual cash flow. Lots of companies look super profitable on paper, but they still go bankrupt. Why? Because profit isn't cash. Cash flow is the real money moving in and out of your project. It's what's actually in the bank. That's the financial reality, the lifeblood of your idea.
So, here's our game plan. First, we're going to cover the 4 core rules you absolutely have to know. Then, we'll get into a key distinction. Is your project structural or marginal? After that, we'll look at 2 different ways to actually calculate your cash flow, tackle the tricky challenge of emerging markets, and then we'll wrap it all up with the 1 key takeaway you need to remember.
All right, let's dive right in and build our decision-making toolkit. These 4 rules are the absolute foundation for getting your cash flow statement right. If you master these, you're already way ahead of the game.
First up, sunk costs. The first rule is really about letting go of the past. A sunk cost is exactly what it sounds like. It's money that's already out the door. It's gone. You can't get it back no matter what you decide to do next.
And here's the bottom line on that. Because that money is already spent, it is completely 100% irrelevant to your future decisions. Seriously. If you include sunk costs in your analysis, you're just going to cloud your judgment. You have to learn to ignore them.
Let's make this super concrete. Say you spent 300 grand on a market study. Poof, that money is gone. Now, what if the study says the project will only make you $200,000 going forward? A lot of people would say, forget it, it's a loss. But that's the wrong way to think. If you do the project, you get $200,000 back. If you don't, you get nothing. So you do the project, because getting some of your money back is way better than getting none of it back.
All right, rule number 2 is all about what you're giving up. This is the opportunity cost, and it's kind of like the hidden price tag on every decision you make. Anytime you use a resource for this project, you're automatically giving up the chance to use it for something else, and that something else has a value. That's the opportunity cost.
This is where people get tripped up all the time. You see a machine just sitting in the warehouse collecting dust, and you think, awesome, that's free for my project. But hold on, is it really? What if you could sell that machine for cash or rent it out? If there's another valuable use for it, then using it for your project is definitely not free. You've got to account for that value you're giving up. Third, we've got overhead costs. Think of these as the general expenses for just keeping the lights on. The CEO's salary, the rent for the main office. The real puzzle here is figuring out how much, if any, of that general cost your new project should have to carry. And our final rule is a big one. You have to watch out for cannibalization. This happens when you launch a new product that's so great, it actually steals sales away from your other existing products. When you're building your cash flow, you have to be honest and ask, are these new sales really new, or are we just moving money from our left pocket to our right pocket? Okay, so let's do a quick recap of our toolkit. Rule 1, ignore sunk costs. They're in the past. Rule 2, always account for opportunity costs. Nothing is ever truly free. 3, be smart about how you allocate overhead. And 4, adjust for any sales you might be cannibalizing. Get these 4 down and you're well on your way.
So now we have the rules, but how do we actually apply them? Well, the key is this one critical question. It's like a litmus test. Is your project structural or is it marginal? Figuring this out is the first step.
And you can really see the difference here. A structural project is something core to your business, like launching a flagship product. It's part of your company's identity. But a marginal project, that's more of a side venture, something you could easily start or stop without really affecting your main business. And that distinction changes everything.
Let's use an example to make this crystal clear. Imagine a snack company has an extra truck just sitting around. If they decide to use it to sell ice cream in the park on weekends, that's a marginal project. It doesn't have to pay for the truck, because if a better use for that truck comes up, they can just stop selling ice cream, no big deal. But if they decide to launch a whole new line of chips, a structural project that requires that truck for deliveries, well, now that project has to account for the truck's value as an investment. It's committing a core resource. See the difference?
Okay, enough theory. Let's get into the practical side of things. How do you actually build this statement? Well, there are two standard ways to do it, two paths you can take.
So you've got two main options here. There's the direct method, which is super intuitive. You just add up all the cash coming in and subtract all the cash going out. Simple. Then there's the indirect method. That's where you start with the accounting profit number and make a few adjustments to get to the real cash number. But here's the best part. It doesn't matter which path you take. They both lead you to the exact same correct answer.
Let's look at a quick example of the direct method. For Project Alpha here, in the first year, you can see cash in from sales was $63,000. Then we just list all the actual cash that went out the door. For supplies, salaries, you name it, that totaled $39,850. So you just do the simple math, cash in minus cash out, and boom. Your cash flow is $23,150. That's it. It's just a tally of money in versus money out.
All right, let's tackle something a little trickier, but super important for anyone working globally. How to evaluate projects in emerging markets. This is where you run into things like high inflation and unstable currencies, which can really complicate your numbers. But don't worry, there's a clear strategy for this. The key is to follow a really clear three-step process. Step 1, you build your forecast in the local currency, pesos, reals, whatever it is, and you have to include your best guess for future inflation. Step 2, you translate those future cash flows year by year into a stable currency, like the US dollar. And finally, step 3, you calculate the project's total value using a discount rate that's also based on that stable currency.
You can see the whole process laid out here. You start local, you factor in inflation, you translate to a stable currency, and then you discount. Following this structured process is crucial because it strips away all the noise from a volatile currency and gives you a clear apples-to-apples valuation that you can actually trust and compare to other projects anywhere in the world.
So after all these rules and methods and strategies, what's the one thing you absolutely have to walk away with? It's an old saying for a reason. Cash is king. Look, at the end of the day, a well-built cash flow statement isn't just a boring spreadsheet. It's your map. It's the most reliable guide you have to get from that first spark of a great idea all the way to a valuable, successful reality. It cuts through all the noise and shows you the financial truth.
So now you have the toolkit. You know the rules, you know the methods. You can analyze pretty much any project that comes your way. The only question left is, which one of your great ideas are you going to put to the test first? Thanks for joining me.